Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Well, g'day everyone, it's Liam Garman here, editor of Smart Property Investment and host of the Smart Property Investment Show. And I'm back today with another episode of the podcast with an investor's journey. Someone who hasn't graced our podcast for, it's been a fair few months, the one and only Steve Kuper. How you going?
Good, thanks, mate. Long time caller, first time listener.
Yeah, and you were practicing that before we came in, and I was really banking on you not executing. But, mate, you and I were talking about your property investing journey. It was a couple of months ago. Now, give us a quick oversight as to where you're at.
I think it was in the context of my brother's journey.
Oh, yeah, I wasn't even thinking about that. But
Yeah,
yes,
it was in the context of my brother's journey, and we've gone about it in very different ways. I bought my first investment property in 2013, and then my second investment property in 2017, 2018.
Yeah.
And then my wife and she had her investment property that we moved into for a couple of years, which we then sold to buy our family home now.
Yeah.
And it's been a bit of an interesting journey in terms of just seeing how the market has evolved and changed. And at the same time, I've seen some, friends come into the market, leave the housing market for whatever reason. It's been an interesting journey. In the last 12 to 18 months, it's gone absolutely ballistic, despite what you might see in the media. I know that some of the outlets are a little more pessimistic and some are more bullish on where the property market's going. But it's definitely been an interesting couple of months.
Well, I think it's very reasonable to say the fundamentals are still there for property price growth. Fortunately or unfortunately, supply is just not keeping up. It's something that we talk about on this podcast quite a lot in terms of those economic fundamentals, which are rightly, say governments are doing a very good job in building a lot of infrastructure. Of course, like what we're seeing in Brisbane, the Olympics, you've got new stadiums, new highways, new train lines being built, as we're seeing in Sydney and Melbourne as well. But what that does is it draws from a very small trades pool, and we just don't really have the tradies that are going on the tools to build new houses.
Yeah.
Supply is really underperforming. Like the government's several 100,000 houses short of their 1.2 million home national housing accord. Meanwhile, we have record levels of migration.
Yeah.
It is literally supply and demand. We will get into that because, Steve, I know you're a political junkie, so I do want to pick your brains on where we see the state of Australian politics going and how that's going to impact the housing market.
Yeah.
I'm going to park that to the side and talk to you. Give us an insight into your two investment properties now.
So they are both in regional New South Wales. I've seen pretty strong growth both in terms of capital and rental return. I'm positively geared. I know a lot of people, and a couple of my mates and I have quite frequent conversations about this. They tend to be negatively geared. I'm positively geared, which has its pros and cons. Main con being at tax time, I don't get a big tax check back from the government. But I was just curious last night, and I was having a look, and I went through the 2022-23, I think it was the last time the ATO released it. But just the number of people in Australia who actually pay tax, who are net tax contributors. And it's quite interesting looking at that. And I know that's a little bit of a segue, but we've got about 16.5 million taxpayers in Australia, of which only about between 1.4 and 1.6 are actually net taxpayers. The rest are
recipients.
Yes.
Yeah. Which is not surprising. I think we've got an $88 billion black hole.
Correct. Yeah. Yeah. And that's a whole, there's a whole podcast series in and of itself around the Australian taxation system. And I know there's been a lot of ongoing debate around the negative gearing and capping negative gearing, which I'm all for, but also because I'm positively geared, so it doesn't really affect me.
Yeah.
What's that old saying that all politics is self-interest?
Well, you know what I find, and there's something that I've been reflecting on quite a lot recently, and I've got to pick my words very carefully. Because what I'm about to say could be divisive, not only politically, but also for a lot of our listeners.
Yeah.
Because I've been reflecting on negative gearing as well, and a lot of calls from fringe political parties, I guess is a good way of saying the Greens, of calling to scrap negative gearing to drive house prices down, or scrap negative gearing returns to drive prices down. But I think even in my own investing journey, the negative gearing to me now is such a non-thought. It really doesn't factor into my calculations and my steps forward, because the rate of migration is so high that the demand for rental properties has grown so substantially that the amount of rent that we're generating is so high that realistically being a couple $100 short at the end of the month actually is just a rounding error. As bad as it sounds.
No, you're 100%
and there are
right,
a lot of Australians out there where, and I'm not being not belittling here. There are a lot of Australians where a couple $100 a month really matters a lot, and that is make or break for them.
Yeah.
But in terms of when we're talking about multi-million-dollar investments, a few $100 at the end of the month that you end up paying really is a rounding error.
Yeah. I think that's correct, and I think about my brother and my sister, who are both a couple of years younger than I am. There's lessons that they haven't necessarily had to learn. Now, as I said, my journey into the property market was very different.
You've got to give us your journey, by the way.
Sorry.
You've got to give us your journey. It's the rules.
Yeah. So my dad was always very clear that buy land, God's not making any more of it. And it's pretty sound advice. And I was never going to buy a investment property in my hometown of Wollongong to start off with, because at the time Wollongong was it was too expensive. It's now, really quite expensive. And I thought, why concentrate my efforts on a area where I'm going to be outlaying so much more, and the bang for buck ratio wasn't necessarily there. So I started having a look, and this was before buyers agents were all the rage. One thing that I can stress for people is do your own research. You've got a host of information in the palm of your hand, whether that's realestate.com.au or domain. Do your own research.
Yeah. You can get a CoreLogic subscription for a couple $100.
Yeah.
And you can have access to all the data.
So it's not hard. There's no substitute for doing the hard yards yourself. And I looked at as I said, both of my places are in regional New South Wales. So one is in Bomaderry, just outside of Nowra.
And that was your first one?
That was my first one, which I bought in 2013. And then my second one is in Queanbeyan, just outside of Canberra. So when the metrics that I was looking for were areas where there was strong and stable employment growth. Now, Nowra has strong, stable employment growth, largely as a result of the Navy being based there, and Queanbeyan being a commuter town for Canberra, as well as a university town with ANU and Canberra University, and then there's a host of public and private hospitals down there. There's all of these different factors that come into play. And then there's the infrastructure. So when I first bought in Nowra, the Berry bypass and the Albion Park bypass had not. They were still very much in the planning stages. They've now since been completed, so you can basically drive from Wollongong to Nowra in, I think it's about 40 minutes.
Yeah.
So that, in essence, makes Nowra now
A commuter town for Wollongong.
Wollongong, but also, by extension, a commuter town for Sydney.
Yep. Yep.
So these are the sorts of things that you have to take into account when you're looking. And even the simplest little, what might seem like a meaningless investment in infrastructure or services at the high level at first glance may actually go on to have very beneficial flow-on effects. Now, when you're putting in major arterial road bypasses, that's pretty common. That's like a pretty glaringly obvious impact. And I've seen, as I said, I've seen really strong growth. I won't tell you what I paid, but I'm about 5x
On both?
on Nowra.
Yep.
And I'm about 3x on Queanbeyan.
On Queanbeyan, which was bought in 2018.
17, 18.
Did you, so throughout this process, you were renting as well?
Yes.
Yep. So you did follow the rent vesting before it was cool?
Yes.
Yep.
Yes. Yeah. So I lived with mum and dad for a little bit and then working full time. By the nature of work, I had to move. I moved to Canberra for about 2 years. I lived in Canberra for 2 years in a of all places. While I was the only professional in the share house. I lived in a uni share house. I was doing staffing hours. You know what they're like. So I didn't see any of my neighbours. They didn't see me. It was ships passing in the night kind of thing.
Was this back when you were living in Redfern?
No. This was before I moved to Redfern.
Pre-Redfern. So that's where we became mates. When you were
became mates again. Yeah,
yes, reconnected.
Reconnected, like ships in the night.
I do like your point, especially around the defence aspect, because this is something that, it really informs my outlook on a lot of investing, which so few people actually raise it. I've been doing this podcast for a long time now, and I think it's myself, Phil Tarrant obviously puts stock in it. Is the defence basing aspect of it, because your point is so correct with those government with the government demand or economic stimulus in an area, because you've got a lot of government employees that are there. That lasts cycles. So we're not talking about a small town outside of Moranbah where the local coal mines shut down. Now 90% of people who are employed there now don't have jobs. Yeah. We're not talking about that. We are talking about the Defence Force will always have a requirement for Nowra, or will always have a requirement for a Townsville, which means you've got tens of thousands of people there that are keeping stock in demand. Well,
yes. And it's not just them. It's the follow-on
the industry surrounding it.
Yeah, and one thing that I would stress, if people are going to look at an area where defence is established, make sure when you get the information from prospective tenants, have a look and see who their employers are, because if they're a government employee, particularly at federal level, and if they are working in, say, a aerospace industry or a defence-related industry, they've all got to maintain a security clearance, which means they're going to be relatively reliable. They're going to be clean. They're not going to be, throwing wild house parties, things like that. So you're going to have a pretty quality level of renter. And I recently I was renting my place in Nowra was rented to a gentleman who was working for one of the major defence primes down there, helping to maintain the Navy's helicopters.
Yeah,
and I had him in there for 4 or 5 years. And fantastic tenant.
Yeah,
and it was. I couldn't fault it.
And you also have the benefit of if you are in defence as a landlord, they got rental assistance. So you're also mitigating the risk of a sudden job loss or a sudden industry move that will always make sure that you're going to have quality income coming in for the long term.
Yeah, and actually, I completely blanked. But in Queanbeyan, I also had a public servant in there, and that also requires maintenance of security clearance. Now he had to go and get posted somewhere, so that ended up being the lease was terminated early, but they pay that as part of the nature of their work, and there's less risk as an investor there for people to bear as an investor, which is, you know, it's not small change when you have people breaking rental agreements, or you know, pulling out air conditionings. I know I've had to replace one of those at one point.
Pull it out.
Yeah, that's a long story.
Yeah, okay.
So that's it's worth thinking about areas that you wouldn't necessarily look at, but take the entire ecosystem of the area into account, because it's going to provide you with something that a lot of people aren't necessarily looking for, and that's to your point.
Now, one thing you did say, so you acquired those two places, and then your wife sold her investment property, and you used that to finance your now owner-occupier.
Yes.
It's something clearly that you both have done very well. A lot of people that we speak to, or I speak to on a day-to-day basis, you know, they find it a challenge even post-marriage, or you've got a life, about the division of finances.
Yes.
Now, clearly, I think you and I are probably on the same boat with this. We've got a big joint account. I put all the money in there, and Lauren, my wife, is officer in charge of all the money, and then she portions it as needed. It's the easiest way to live, but not everyone does that, and a lot of people do have those walls, have those divisions. I guess it might be a bit of a more in the sky topic. How was that in terms of you guys bringing this all together and then getting that family house?
The silence makes it sound like it was a bad experience, but it wasn't.
But you know what I mean? Because I even speaking to a lot of married couples now, and they have joint separate accounts, or they have the kind of if I get divorced account, which, you know, your prerogative. But I can only imagine it would very much be an impediment to rapid financial growth if you've both got secret squirrel accounts that you're shoveling money away into, rather than, I don't know, putting into new properties.
Yeah, so we have a joint account, and then we have a joint offset that's set against our owner occupied. The rental return for both properties, it pays off the mortgage, which is nice. Yeah,
that's fantastic.
Yeah,
yeah. So you're very much hedged.
Yes.
Yeah.
Yeah. And then we've got our own separate accounts.
Yeah.
And we've got the common credit card. And my experience was interesting because I was working in government at the time, and I have periodically fixed my loans, my mortgages for the investment properties, and I had just come out of a fixed rate. I won't mention the banks. And this was end of 2021.
Yeah. Okay.
So very much still post-COVID hangover. And anybody who studied economics knows that as soon as you start seeing mass amounts of quantitative easing, for people who aren't familiar, that's money printing, you know that inflation is going to kick in.
Yeah.
Now, what we saw as a result of all the QE during COVID was there was about a 6 to 9 month lapse from the money hitting the market to the inflation starting to bite. So I was watching that. I was watching what was happening with the US and the EU central banks, and keeping that in the back of my mind, along with some analysis done by some podcasters, listening to that and thinking, okay, this is not good. So February of 2022, I started looking to fix my loan again.
Yep.
And my bank at the time, I said what I wanted to do was I want to fix my home loan for 5 years.
Yep.
And I want to halve my loan term.
Mm.
So I want to go from a 30-year investment P&I loan to a 15-year investment P&I loan. And at the time, the bank laughed at me. Now, mind you, my LVR at that time would have been sub 60%.
Yep.
But they laughed at me. And they said to me, go somewhere else. And that was their retention team.
Yep.
So,
I mean, you did ask a lot.
Well, did I?
5-year fixed at that point was cheeky. No, I mean, it was a great idea.
Yeah.
It was a fantastic idea, which is probably why they thought it was a bit cheeky.
Yeah.
Yeah.
But I walked down the road, went to another bank and said the same thing, and I got it.
Wow. So you're still on that now?
Yes.
What's your interest rate, if you don't mind me asking?
3.64, I think.
Yeah.
Something like that.
Do you have any idea how much it will go once you're off fixed? How much it'll go up?
I think it'll go to whatever the variable rate is. But
in terms of mortgage repayments, how much more?
That's a good question. I am not sure. It'd probably go up. Well, so the way it's been structured is by the time that 5 years is up,
you would have paid off a lot of the principal.
2/3 of my principal. So I'll have a third of the loan left to repay.
Yeah. Yeah. So you're on that tail end where a lot of it is just principal
anyway.
Yep.
So my interest rate, I can tell you, is 3.84. 3.84.
Yep.
And I remember at the time, a couple of my colleagues were laughing at me. They were like, "Why are you fixing your rates? Like we're going to get another rate cut." And I was like, "No."
And it's funny because you could make the argument. I remember at the time, or just afterward, maybe a year after it, when we did start seeing interest rate increases, I actually got into an argument with my friend who I kind of stand corrected. But he raised a good point, which is you could make the argument that we waited too long to increase rates because the amount of money flowing into the economy and the amount of spending in the economy was so rampant that a lot of the demand was for two reasons. One being obviously the cost push, the cost of global shipping, fuel, oil, etc. all obviously went up. But internally, we also did have artificial demand because everyone was furloughed essentially, and everyone got money from the government.
Yeah.
So we did have very artificial demand growing of people sitting at home and ordering stuff online.
Yep.
So turning that into a discussion with your political background.
Yes.
State of the property market now and for the next 12 months, what are your predictions?
I think we're going to see some explosive growth.
Yeah.
But at the same time, I don't think that the concerns of first home buyers, particularly Australian first home buyers, are going to improve. If anything, I think it's going to get worse.
The what, sorry? The concerns.
The concerns, yeah.
As in their affordability?
Yep.
Yeah, of course.
And their ability to actually compete. Because if people go through and have a look at the first 5% first home buyers grant, there's no actual Australian citizenship requirement, and you don't have to be an Australian taxpayer to meet the 5% first home buyer obligation. So that's going to add fuel to an already raging fire. And that's just going to create a whole host of social and economic problems that I don't think that the government or opposition for that matter are particularly equipped and or prepared to deal with at this point.
Yeah. To your point, you mentioned earlier that even back in 2013, I can imagine looking back now in 2013, relatively Wollongong would have been very affordable for you.
Yes.
Right?
Yeah.
But you, at your young age, you mid-20s back then?
23.
You were 23. Back then you saw the risk of being over-leveraged, so you went south to Nowra to buy.
Yeah.
Which is the exact opposite of what the government's looking to do with the first home buyer guarantee. And a lot of our listeners on this show, I've said it 1,000 times, but just, for the sake of this argument, I've been saying it for months where, you are at risk of negative equity when you put down 5%.
Huge risk.
All it takes is, do the maths. All it takes is if you have a bad few months, you lose your job, you have to sell, which does happen. You're going to get back less than you put in when you factor in selling costs for your selling agent, marketing, conveyance of this, that, all the little taxes and fees that when you get at the end just magically sum to a way bigger number than you expected. There is a huge chance that if you do have a bad few months and you have to sell, you're actually going to lose a lot of that 5% that you put down. You ain't getting it back.
Yeah.
And especially, you're going to be paying 75, 80% of your first few years of mortgage repayments on interest anyway.
Yeah.
You're barely going to be scratching down that principal in your first few years. I think a lot of first home buyers will put themselves in a remarkably dangerous place. What some people say on the flip side, which is, the government's only covering LMI. That's the only difference. What it does, though, is
removes the moral hazard.
Well, removes the moral. That's a great way of putting it, because it also forced an element of introspection. It forced an element of introspection, which is your mortgage broker saying to you, "Hey, Steve, just so you know, you're going to have to pay $12,000 more." Why? Oh, because you don't have this. You need a 20% deposit, and this is to do da 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 da. So it does add an extra barrier for people looking to get in.
It does. Now one thing I'd like to say is that what the government is doing right now, and I don't think this has been effectively communicated very well by many people and very many media outlets, is that they have basically what they have done is taken the playbook of Fannie Mae and Freddie Mac and said, that's what we're going to do.
It is a huge risk.
Now,
it is a huge risk because if you're going to compare it to 2008, and we can look back and it's quite comical in the US of people making fraudulent bank statements, da 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 da. We look back, that would never happen here because we got good regulations. Well, we do have good regulations, but on the flip side, we laugh at it because, here's a fake bank statement, you never earned that much. Well, we're also giving loans to people, or potentially giving loans to people that have no demonstrated ability to actually make a repayment.
Yeah.
If you've only got $50,000 to put down for a $1 million home, you don't have the long-term demonstrated ability to save or make mortgage repayments.
Yeah.
So in that sense alone, it is very similar to 2008.
And I don't think people are prepared for that. What happens when, and that's to my point earlier, that I don't think either the government or the opposition are particularly well attuned or have done any serious deep thought around what it looks like if the bubble bursts here.
Yeah.
Particularly as more and more people can continue to...
It's because it's in the too hard basket. Yeah, it's in the too hard basket. And this is why, this is why I do have a little bit more trepidation to it. And a lot of investors out there would be thinking, this is fantastic. There will be this FOMO, fear of missing out, for a lot of young people, and you're just going to see billions of dollars entering the market.
I like FUD. Fear, uncertainty, and doubt.
Yeah, FUD. We'll go with FUD. This is going to be great. Property prices are going to go up. Therefore, I'm wealthier. You want it stable. You don't necessarily want to rock the boat of the entire Australian economy, because if you do that, then actually house prices could tumble in the future, especially if you have a generation of people in negative equity.
Yeah, and at what point, for somebody like me, if you're in negative equity, that's better for me, right? Because life's a competition, whether people like it or not. It's a competition, and you have exposed yourself, necessarily or unnecessarily, and you're in a weaker position. So I've got more strength and I can bargain. I've got more leverage to bargain.
100%. And I will say, this isn't a bash the Labor government thing, because I know you're probably not going to comment on this, but I will. I similarly thought that the coalition's policy of $50,000 superannuation to buy, I thought that was similarly bad.
No. I'm fully in agreement with you on that. I think
for the same reasons.
Oh yeah,
for the exact
it's just
same
artificially pumping. It's just artificially driving up property prices.
Yeah.
And that's the thing. Like people are, and this is what I try to communicate to my brother, threading it back to what we began with, was that I was trying to give him the advice that partly that my dad gave me, our dad gave me, but also that, think outside the box and don't over leverage yourself, because you were standing next to him or sitting next to me in the office when I was on the phone with him, and he told me what his plan was, and I was like, "You effing what? No, don't do that, because A, B, C, and D." And he was basically going to try and put himself. He was trying to crawl before he could run.
Yep. Run before he could crawl.
Run before he could crawl. Yeah. Sorry. Yeah. Well,
yes, and I do agree. There's there's a time and place for it. So if you're a lot of people listening to this podcast, they're seeking that kind of professional education, I guess, or that extracurricular education. I'm very risk seeking when it comes to it. I will bleed my bank account to zero to buy. I will bleed it to zero to buy, but I'm also a sophisticated investor enough such that I know the calculated risk that I'm taking.
Yeah.
And I've also structured my life in such a way that I can get myself, pending a major financial crisis, that I can work my way out of it.
Yeah. But you're auditioning for post-apocalyptic warlord as well, aren't you?
I am. Yeah. Which is why you need to own the land.
Yeah.
But there is a risk where, especially with a new crop of like influencers and buyers agents online, where they are offering financial advice.
Without the regulation.
And I think that it's very interesting, the argument around regulating the sale of property as an asset class, which I've been dwelling on quite a lot recently, because a lot of people in the left in particular, housing is a right, housing shouldn't be an asset, it shouldn't be a commodity. I almost take it the opposite, that if you regulated it as if it was a commodity, if you regulated it as if it was an equity, and you had oversight on financial advice and the way that we're trading this, I think you would have a more efficient, more streamlined, and a more fair property market.
Yes.
Okay, I'll give you more of an example.
Okay.
I couldn't. I wouldn't financially be allowed to do with shares, insider knowledge, first movement, as a market tanks, first mover advantage, things like that. You cannot do. ASIC and the ASICs will be onto you very, very quickly. They are very, very sophisticated. Things like this do not happen in the world of property. So ironically, if you did have more oversight on it and the way that it's traded, I think it'd be a more fair and efficient system.
Yes. Yeah, I can see I can see the point. I'm just, my instinctive response is to thrash against any form of overzealous and unnecessary regulation.
Yeah.
I think if you're going to look at anywhere to to review regulation, I think a big one is your stamp duty.
So you're not pro stamp duty?
Oh, no way.
Yeah.
No.
Yeah, I don't mind it.
No.
Probably just lost all my listeners.
It's dead money.
Yeah.
It's money for what?
Well, to keep the country functioning.
Well, no, that's what the GST was originally supposed to be. The states were supposed to get rid of GST Stamp duty to be supplemented by GST.
Was that the actual agreement?
Yeah, there was that part of it. Yeah,
When 96 or something.
yeah, was it 96? Yeah.
Yeah, right.
So, what I'll put it to you this way: if you want to stop something from happening, what do you do? What does people? The government wants to stop people from smoking. What do?
What have they done?
Yeah, tobacco excise.
Yeah.
Right? So if they want to stop people from building houses, buying land, developing it, they tax it.
Yeah.
And you see that with the host of new taxes that go into property developments, and I do genuinely think that's part of the reason why we're seeing our western suburbs of Sydney and Melbourne and Brisbane and Perth turn into, quite frankly, grotesque box cities that are absolutely appalling places to live, and I live in one.
Yeah.
Because the costs are so prohibitive to get a block of land developed that they have to pack everybody in to make as much profit as they can.
I mean, on the flip side as well, I mean, there are ways you can make it beautiful, but I think in Australia we surrender ourselves to what could be. We don't even bother trying.
I think that's, I mean, you and I, we quite frequently swap Instagram stories of beautiful suburban streets in the US. And,
and I mean, look, even in terms of boxing people in, right? You go to the UK. Now, obviously they were homes for workers in factories and mills, but you have beautiful terraces.
Yeah.
Beautiful terraces.
Yeah.
There is nothing stopping us from having beautiful terraces except a will and a desire.
Yeah, you can just do things.
Yes, like these things are achievable. And I in terms of the supply debate, the NIMBY, I fall in the middle, which is, yes, I do believe that we need to have a lot more supply come on. That's not negotiable.
Yes.
If you have a migration rate this high.
Because what are we at now? It's about 1,800 officially a day?
Migrants.
Yeah.
So you'd need at least, to house them, if you say 3 people per house, you're going to have to get like 600 houses a day built. These are astronomical numbers. You have to increase supply. So I acknowledge that from the YIMBY side. But in terms of the NIMBYs, I also do understand a lot of their concerns, which is your point. A lot of these new builds are just horrific. They are horrific. They're riddled with structural defects, especially the unit buildings, the unit blocks. 53% or so of new unit blocks have major structural defects within about 6 years.
One of my friends lived in the towers in...
Oh, no way.
Not Opal Towers, but the ones in Mascot.
Yeah.
And we moved her out the week before they started becoming media knowledge that they were falling apart.
Yeah.
And built by a very large property developer.
Yep.
We all know who...
I think I know who you're talking about.
Yes.
In Australia?
In Australia.
Yeah, okay.
I think he's the wealthiest man in Australia at the moment.
Oh, I see. Yes. Okay.
And you were lucky if you could flush the toilet.
Wow.
Because for whatever reason, there was...
Just didn't work.
It didn't work.
Just nothing worked. And that's the thing, we've surrendered ourselves to what we can achieve. And that's why I do agree with the NIMBY side of the argument as well. It's like, would you want these horrific monstrosity of buildings near you? I used to live in the inner west, and I remember some of the towers that were being built in Burwood, and it just looked like 1970s Soviet era crap. It's like, how does this pass? Like, who looks at this and says, this inspires beauty, this inspires me to be my best self?
Yeah, but it's also it's incumbent on us and on investors and Australians in general to have a conversation about the sort of country that they want to live in. Do you want to live in a country where your cities look like, quite frankly, every other boring, bland, concrete jungle in the world?
Yeah. And there's there's an example, going to New York, right? You like New York.
I love New York.
What New York does is, like, a lot of the big buildings, they're beautiful. You can have high density living that's beautiful and efficient. Yeah. It actually can be done.
Yeah, big fan. I actually follow one of the preeminent New York classical architects on Instagram.
Yeah.
Robert A.M. Stein, and his buildings are beautiful.
You can have
You
it.
can have it.
You can have it
Yeah.
should you wish, which then adds to the complexity, because that's when your local protest groups push against supply. So looking at this, in summary, so turning it back to investing, $88 billion government black hole, that's putting money into the economy, very high paying government jobs, which frankly too many of them exist.
Yep.
You're coupled with interest rates kind of tapering down a little bit, coupled with a lot of new money coming in from first home buyers, coupled with everything that we've spoken about, migration, supply. It's probably going to be a bumpy year ahead.
Yeah, I'd say the next 12 to 18 months is going to be very interesting. That's bar any global shocks.
Yep. Which may still happen.
There's, steering into my professional wheelhouse for the in my day-to-day job,
Which is you're a defense writer. Yep.
We've got the ceasefire in the Middle East now, which is fantastic. For that alone, I think President Trump should get the Nobel Peace Prize. And I note that Democratic Senator John Fetterman has actually come out and said that if it sticks, he will be the first person to nominate from the floor.
Wow.
For President Trump to receive the Nobel Peace Prize.
A Democrat said that?
Yeah.
Wow. Does the peace look like it's going to hold?
Still too early to tell.
So what's happening more broadly, globally? What shocks might be on the horizon that could have economic ripples in Australia?
There is the ongoing conflict in Ukraine.
Yep.
There is a host of economic problems in Europe that are being papered over. The UK is in very dire straits economically. And then there is the double-edged sword that is our over-reliance on China. There are significant structural problems economically with China. And then there is their broader geopolitical ambition to dominate our region.
Yeah.
They are all very real challenges that could have significant impact on the health and the vitality of the Australian economy. Look at the economic impact that the coercive trade tactics that China's engaged in with banning BHP's iron ore has had.
I would say, for a lot of our listeners that don't necessarily have their fingers on the pulse for the geopolitics, for the global national security around this, I think it actually might come as a surprise to a lot of people that the trade bans have actually come, because we've been talking about it for years where they banned was it barley
and rock lobster
and
wine.
wine, multitude of things. But I think a lot of people in cities didn't even make an impact on their day-to-day life. They wouldn't have even known.
No.
So, what would you say to people that might think that, well, she'll be right?
Huh.
But you know what I mean?
Yeah.
If it hasn't hit a lot of people's back pockets, then, she'll be right.
Trying to think about how best to I would say that this world, the one that we currently live in, is an aberration. This is not normal. The peace, the prosperity, and the stability that we have enjoyed for the last 80 odd years, maybe I'll give it a century. The last 100 years has historically been an abnormality, and our world is now becoming more like the 18th and 19th and early 20th centuries than it has been for the preceding 80 years.
So what does that mean?
Conflict's more likely. Nations are going back to competing in their own best interests and putting their own national interest first. And I think it's not unlikely that we will see greater conflict in our region. We're already seeing Thailand and Cambodia having a fight, another one.
Yep.
There's China and the Philippines.
So what you're saying is
Buy gold.
Yeah, buy gold. What you're saying is we our time's an anomaly, and we're going back to
Don't take it for granted.
Don't take it for granted. It can end.
Yeah.
Yeah.
All good things must come to an end.
And on that very dark note, thank you very much for your time, Steve.
You're welcome, mate.
That was Steve Kuper, our defence writer here at Momentum Media. That is all we have time for today on the Smart Property Investment Show. But until next time, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.